Investing is one of the smartest things you can do to grow your money over time. But the problem is most people are confused where to start. So here is clear step-by-step plan how to start investing in 2025. Well, leaving your money into savings account actually is not enough. While most savings accounts pay 1 to 2% interest, while inflation rises 3% or more. Let's start with obvious. Why should you invest? Like, suppose you're savings your money in savings account while you're getting 1 to 2% interest rate. On the other hand, inflation rising around 3% or above. So that means over the time you're think of it like this. Suppose you have $1,000 and inflation rate is around 4%. So the next year same 1,000 would be around $960. So basically it lost $40 its value in just 1 year. And that's because of the inflation, which is so bad. That's where investing comes in. Investing allows your money grows over the time. Instead your money is sitting ideally, it grows through compound interest and market gains. Compound interest is one of the most powerful force in finance. It's not only make your money on your original amount, but also on the returns you have already made. For example, if you invest $100 per month at an annual return 8%, after 20 years you will have almost around like 55,000, while you only invested 24,000 of your own money, which is pretty good. That's why starting early does matter. The earlier you begin, the more time your compound growth has to work for you. Before you start, you should know where you're investing. Your goal should determine how much risk you should take and what type of investments are right for you. Some common goals are retirement savings, trying to buy home in next 5 to 10 years, then building wealth for long-term financial freedom, or it could be savings for your child education. So if you're investing for long term, suppose like it's 20 or 30 years, you can take more risk because you have more time to recover in the markets. And if you look in the history, markets tend to recover for long term, so it's fine. This means you can invest in higher growth return like stocks, ETFs. But if your goal is more short term, like buying a house in next 5 to 10 years, you need to be more careful. You should be investing in mutual funds, gigs, or other safe investments, or you could go for like high interest saving accounts. A mistakes beginner does, like investing without clear goals. This often leads to panic selling when market drops or chasing risk investments without long-term plan. So having a plan helps you to stay focused and disciplined. Before putting your money, you need to understand the basics. There's some basics about many different options, like stocks. It's when you own a stock, you basically own part of that company. When that company does well, the stocks goes up, and also some stocks also pay dividends, which is portion of the company's profit shared with the shareholders. Well, there's another called ETF. ETFs are basically a bundle of stocks, bonds, or other investments grouped together. When you buy an ETF, you're investing in so many companies at once. That makes it less risky than individual stocks, but great choice for the beginners. Another investment you can do which is like mutual funds. Mutual funds is more like ETF, but they are actively managed by high professionals and they tend to have higher fees. So less of your money stays invested, so you need to be more careful before you start investing. Now we have also a bond. Bond is basically a loan you give it to government or company. In returns, they promise to give you a return, which is basically lower return than individual stocks or ETF, but it's basically safer than the others. To invest, you will need a brokerage account where you can buy and sell stocks, ETFs, and other investments. If you're from US, you can go with Robinhood, which is simple, free trades, and good for beginners, or you can go with Fidelity, which is reliable, low cost, with good education tools. In Canada, there's two major brokerage, which Wealthsimple Trade and Questrade. Even though Wealthsimple Trade offers no commission and they're so much beginner friendly, on the other hand, Questrade has low fees and that's great for beginners and advanced trader. Here are a few things to consider when choosing the platform. Low fees or no fees, fractional share investing, an easy to use app or website, or even access to ETFs or index funds. Be sure to pick right type of account for your situation. In Canada, you can choose TFSA or RRSP, or even if you're from US, you can go with the Roth IRA or even 401. Each account has different tax advantages, and so it's worth understanding before you choose. Now what you have to do is start small. Another misconception is that you need a lot of money to start investing, which is not true. Many brokerage accounts allow you to start with even 5 to 10 or maybe 20 bucks, thanks to fractional share where you can buy portion of a stock or ETF. What matters is not how much you start with, but how consistently you invest. Set a fixed amount, maybe $50 or $100 a month. Over time, your money can increase when your salary increases. Waiting to invest until you have larger amounts saved up to invest is a great mistake. It's better to start early and let time work in your favor. The final and the most important thing is being consistent. Investing is not about quick profits. Markets rise and fall in short terms, but over years and decades, they tend to grow. The key is to set up an automatic deposit so a set amount of your money moves from your bank to your investment account without you having to think of it. This is not only makes investing a habit but also takes advantage of dollar cost averaging. Buying stocks at a different price over the time lower the risk of your investment. The mistakes new investors make is panicking when market drops and selling everything. When you are investing for long term, some drops sure matter and they recover historically. For those who stay consistent actually make money, to be honest. Remember the rule, time in the market beats timing in the market. It's about how long you stay invested, not when you buy it. So here are some final thoughts. Investing might feel complicated at first, but it gets easier when you start understanding the basics. Start small, be consistent, and focus on the long term. The more time you stay in the market, and you'll be amazed how much your money can work for you. And the one last thing, keep learning. The more you understand about money, the better decision you'll make in the future. Thank you so much for watching this video. I hope this video helped you in some way, and if you want, you can just hit the like button and subscribe to my channel. And if you have even any question about this video, or you want me to make video on something else or any other topic, you can just let me know and I'll try to do it. For now, bye, see you.